This podcast is brought to you by Customplan Financial Advisors, Inc., an independent insurance managing general agency in Canada. Financialpodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello, and welcome to the Financial Podcast. My name is Gary Poyer. The Financial Podcast is brought to you by Customplan Financial Advisors, an award-winning managing general agency that provides exceptional support and resources to the independent financial advisor. Please visit customplanfinancial.com to see all the resources that are available to you, the independent financial advisor. Today, we're going to be talking about a topic that I think a lot of people view as something that is reserved only for the very wealthy or for those that have very complex financial affairs. And that, my friends, is the use of personal trusts. And today we're very fortunate to have with us from the Calgary estate planning law firm Carscallen, Shannon James. Welcome, Shannon.
Thanks, Gary.
Shannon, why don't we begin by having you tell us a little bit about yourself?
Sure, thank you. So my name is Shannon James. I am an estate and trust litigation lawyer. I deal mainly with disputes about estate, trust, and tax. I have a background in this area from my time at a national law firm. I spent 10 years in the national law firm and recently joined the Carscallen firm, which is a local firm that is focused on serving the citizens of Alberta in their businesses and personal affairs.
Excellent. Shannon, am I wrong in thinking that a lot of people view trusts as something that is reserved for the very wealthy or those with complex situations?
You're absolutely correct. People hear trusts and they tend to think trust fund or trust fund kid and all that comes with that. But that's not necessarily true.
Okay. And why don't we begin by maybe defining what a trust even is?
Sure. So a trust is a legal relationship. It's an obligation that's created in equity where one person, the settlor, sets aside a piece of property and confers it on the trustee, who has the obligation to hold that property for the benefit of a third group of people, the beneficiaries, who will have an interest in actually using and enjoying that property. And the trustee's obligation is to manage the property for the beneficiaries.
Okay, so there's three parties to a trust.
Typically,
Settler,
yes.
Trustee, and beneficiary?
That's right.
Okay. And are trusts, are they governed by any legislation at all?
Yeah, so trusts are governed by legislation. In Alberta, it's the Trustee Act. And this is a piece of legislation that sets out sort of bare bones rules about how trusts are managed. But a lot of the rules around trusts are actually set up within the trust document itself. So trusts can govern their own procedure and set their own rules to an extent. And then whatever isn't in the deed is completed by the provincial legislation.
Okay. Is there a minimum age that a settler has to be in order to create a trust?
I don't actually know that, but I suspect it's 18. Gary, you might want to edit that piece. Okay. But yeah. Okay. So, a trustee, settler, you said, right?
Yeah, settler. Yeah.
Yeah, I suspect it's 18 years old, but.
Yeah, okay, that makes sense. So the age of majority.
Yeah.
It seems to be pretty standard across creating a will, for instance. Okay.
Let's just assume that it's a person over the age of majority. Yeah.
Okay. Yeah, that makes sense. And what about the necessity to have it in writing? Can a trust be oral?
Yes, a trust can be oral. It is a misconception to think that a trust absolutely has to be in writing. Trusts can be oral or in writing.
So if it's oral, how do you even prove the existence of a trust?
Well, that is the tricky thing. At that point, suppose you say, I am setting aside this bank account and it is to be held by you for the benefit of my niece and nephew. establishing the trust can be a little bit tricky if you don't have anything in writing. And at that point, you would be looking to witness testimony or other information from people who may have seen or heard it or participated in the creation of that trust.
Okay, wow. So it could take a while in order to prove the existence of the trust.
It can be challenging. And the other thing you might have to look at is the pattern of behavior. How was it actually handled? So when you're setting up a trust and when it's your intention to set up a trust, it's often the best thing to actually set it down in writing.
Right. Okay. Well, that makes sense. You mentioned just a minute ago that a trust is a relationship. Is it a legal entity in itself, or is it, like, from a legal perspective, what, other than a relationship, what is it?
So from a legal perspective, trusts don't have what we call legal personality. That is, they don't have the ability to enter into contracts by themselves. They can't sue or be sued in their own name. So a trust in that sense is not a legal entity. But for other purposes, like taxation, trusts are actually subject to tax as an entity themselves. So the answer to your question is no, they're not a legal entity, but they can be treated that way in certain circumstances.
Okay, that's kind of interesting. I guess, quite often in coming from a banking background a little bit, people will open up a bank account in trust for their grandson. How is that kind of a trust account separate from a true legal trust?
Well, so those arrangements, those trusts, they are still funds held in trust for another person, in that there is, the bank is holding the funds for the benefit of somebody other than the person who owns the funds. So for grandchildren instead of grandparent. But what's a little bit different is those are typically not discretionary. Those typically don't allow the trustee, so the bank, the ability to actually assess the situation and determine how the funds are managed, one, and how they're distributed, two. So the purpose of how those trusts are used is a little bit different.
Yeah, I was going to ask you who the trustee was in that situation, but it's the financial institution.
Well, I mean, it depends, right? Who's actually making the decisions to dose out the money? Typically, it's the financial institution is the trustee in the sense that is holding and caring for the money, but they may be more of a custodian, taking instructions from somebody else. So maybe the grandparent at that point.
Okay, that's interesting. So why do people create trusts? What is the purpose of a trust?
Well, there's all kinds of reasons that you create a trust, and there's all kinds of purposes for doing it. Some of the common ones that we see, because really what a trust is, that its function is to manage property for somebody else. So we see them an awful lot in situations where there might be a challenge to managing the property. So second marriages, you might see a trust put in place in a will to ensure that the spouse is looked after, but the kids of a previous marriage still get their inheritance. Or you might have a situation where you have a disabled child who's going to need to be looked after you're gone. You might set up a trust there, or a spendthrift, or someone with addiction issues, or a very large amount of wealth that is being held for a lot of people. You might consider putting in a trust in those cases. It's always, the real function is to manage property.
Manage property. Okay. So, over the last few weeks, we've done several different podcasts, and one of them was on wills, and the term testamentary trust came up a lot.
Yes.
So, what is a testamentary trust, and how is it created?
Yeah, so a testamentary trust is a trust that takes effect after the death of the person establishing it, after the death of the settlor. And they're typically, they are created by a will. So what happens is when you create your will, you might decide to just give out your property outright. You might say, I leave everything to my spouse. But you might also decide to create a testamentary trust. And that, again, the function is to manage property over time for the benefit of someone. And you would set up your will a little bit differently, where you would specifically say, this property is set aside for these people in trust, and these are the rules to govern that trust.
Okay. So rather than just giving property to a beneficiary, there's like conditions attached to it?
Yeah, so some common ones might be, I leave my my estate in trust for my son until he reaches the age of 30. He ultimately is going to have the benefit of that property, but he doesn't get it as his own property outright until the terms of the trust are fully satisfied. So, for example, until he reaches the age of 30. Now, in the interim period, the trustee can usually pay out money for their support, for their education, to keep them housed and clothed and looked after. But the money doesn't truly become theirs until later. So that's a common way that we see a trust set up in a will.
Okay, that makes sense. Poor son, he has to wait until he's 30 to get the funds, but father knows best, maybe.
Maybe,
mother,
yeah.
in this case. I just want to back up for a second and talk a little bit about the trustee. So the trustee has legal title to the property.
That's right.
Okay, now, so if I'm the trustee, because I have legal title, can I sell the property and pocket the money myself?
Well, so no, you can't pocket the money. Now, trustees, they're what we call fiduciaries. They have special obligations, very high level of obligations towards the beneficiaries. And one of the main duties of the trustee is to act with the utmost best interest of the beneficiaries in mind. So while a trustee might be allowed under a trust agreement to sell the property, to mortgage it, to do all sorts of things with the property, it's the turning around and pocketing the money, the self-dealing, the benefiting the trustee that is the real problem. And in fact, that is likely a breach of trust by the trustee.
Okay. So, so the settler, when in creating the trust, creates the terms and conditions as well.
That's right.
Okay, so in the will, then the testator and the settler are the same people.
That's exactly right.
Okay, so that, let's say I'm the settler, I create some terms and conditions, put them in the will. The trustee is then governed by those terms and conditions. Or is it possible to have the terms and conditions outside of the will?
Well, yes and no. Typically speaking, the will is going to govern. The rules as set out in the will are going to govern, but wills also are subject to legislation. So there's rules about how estates are administered, so what a trustee can and can't do. Wills are also subject to things like family maintenance claims, so wills can be varied. And the other thing is that estate trustees, executors, or personal representatives, as we call them in Alberta, can apply to the court for directions about how to manage an estate. So, for example, that might include getting the court's advice about how to deal with a particular testamentary trust.
Okay. Okay. So, with the testamentary trust, the terms and conditions are normally inside the will, right? Now,
that's right.
What about the other kind of trust where it's created when somebody's still alive? What is that kind of a trust called?
Yeah, so that trust is called an inter vivos trust, which means among the living or between the living. And that's a trust that's created during the lifetime of the settlor, and it takes effect typically right away. Those trusts are to be used before the settlor has died, and they can be used for a very, very long period of time, even beyond the settlor's death.
Okay. And what is other than one is living or created when a person's alive and the other upon death, is there any other major difference between the two types of trusts?
Yeah, so there's a bunch of differences. So typically, a testamentary trust is irrevocable. It can't be changed. It's in the will, and it doesn't actually take effect until the settler dies. On the other hand, inter vivos trusts are a little bit more flexible typically. They're more subject to change and evolution. And the settler is often still around to be involved in those processes if it has to happen. So those would be some of the key differences. They're taxed differently, and they achieve different objectives. So One example is that an inter vivos trust might be used to pay a family's expenses while everyone is still living and still going, and in a way to distribute income among the family members and resources among family members in a practical, sometimes tax effective way.
Okay. Our audience is basically independent financial advisors. So what I'd like to do, Shannon, is just talk a little bit about how a trust could be used by their client and how a financial advisor can maybe position a trust with their client. Because chances are a lot of our financial advisors' clients have a lot of wealth, especially in Alberta and BC, and they may not even be aware of a trust, or again, thinking that a trust doesn't pertain to them. They don't qualify for a trust. So just talking about testamentary trusts, you mentioned earlier it could be for a spendthrift child.
That's right.
Yeah. What about in a situation where the parents have life insurance policies? So let's say they have $1 million policy each. They've got 2 kids. Kids are minors. Parents go for groceries, get hit by a bus. They're both killed. $2 million comes into the hands of the children. What would you suggest happen in that case? Because obviously the kids can't manage the money.
That's
let's say that there was a trust set up.
yeah.
What happens in that situation?
Well, so if you have a trust, you've got a more seamless situation in the sense that the money is absorbed into the trust. It's contributed into the trust, and there's somebody who's built in there to manage it. The trustee takes over. They can invest that property. They can manage it over time. They can make sure that it's protected. They'll file all the tax returns for any growth. And what they can do is monitor the needs and the wants of the beneficiaries, so the children. Like, are they going to private school? We'll keep paying for the private school. Are they taking swimming lessons? We'll pay for the swimming lessons. And it's a more seamless management in that case, because there's somebody in place who is able to take over and ensure that that money is looked after. The flip side, if there isn't somebody there, is you'll have to have someone appointed to deal with these children's money. And that can involve bringing in Alberta, it's the Office of the Public Guardian and Trustee, who are responsible for protecting minors' property. In that case, you're looking at court applications, you're looking at complicated proceedings to try and make sure that that money is properly managed. And it frankly can eat up a lot of the money in the legal proceedings, and it can also tie up a lot of the money just in terms of being able to determine who's got the authority to deal with it. So in that situation, the trust sets in motion some management right from the get-go.
Okay, so if the parents had some foresight, had these big life insurance policies in place, created a trust within a testamentary trust, appointed a trustee determines how the income is paid out to the kids. If there is no will or no trust, the public trustee gets involved?
May have to, yeah. So someone will have to engage the process. First of all, someone who is looking out for the children is going to have to engage the process to figure out where the money goes. And necessarily where there's money going to minors in this province, you're engaging the assistance of the public trustee.
Okay.
Yeah.
So let's say that there is a will in this situation, but no trust conditions created, then the public trust would get involved, the public trustee of it?
No, so it depends here. I'll have to back it up a bit. It depends how this policy is paid out. So if the policy pays out to the general estate of the parents, if there's no named beneficiary, then the property is administered in with the rest of the parents' property. So if their life insurance proceeds fall into the estate, it becomes part of the estate and is dealt with all of the other assets of the parents. If there's a designation that's a little bit different, and in that case, you might need to look at somebody, if you designate a minor child as a beneficiary, at that point, you're going to need some sort of trust established to be able to look after that money.
Okay. So, as a financial advisor, if I'm talking to my clients about a large insurance policy, maybe the kids are named as the contingent beneficiary, because the parents have named each other as primary, then the financial advisor should be talking to the parents about a trust in order to control that money, I guess, beyond the grave.
That's right. They might want to speak to the client to suggest to them they get some advice about how you can manage that going forward for minor children, including through the use of a trust.
Okay.
Yeah.
And if the parents or the clients are having a will prepared, do most lawyers talk about trusts at all? Is that something you guys would do just as a routine?
Yeah, so from our perspective, it's almost automatic. If a couple comes to me and says, we'd like to make a will, if they have minor children, the conversation of trust is going to come up automatically. For example, if you say, I'm going to leave everything I have to my spouse, and if not my spouse, to my kids in equal shares, a really important next question is, how old are your kids? And in the event that your spouse goes before your kids turn 18, how are we going to make sure this money is properly managed? And then that sometimes leads to a discussion with the parents about, maybe our children aren't going to be ready at 18 years old to have a large amount of money. Maybe we do want to set some limits about how our wealth is going to be transferred to them and used. So the discussion about trusts when you're making a will should be more or less automatic.
Yeah, that makes sense. And that's another reason to use an estate planning lawyer to have the estate planning documentation prepared as opposed to the will kit.
Yes.
Yeah.
Yes.
I don't think, not ever having read through a will kit, I don't imagine they cover trusts in any detail anyway.
Well, I don't personally have a great deal of expertise in will kits either, but I would imagine that there could be some pieces missing there. Yes.
Yeah, for sure. Okay, so a testamentary trust can be used for minor children. You mentioned about adult children that are maybe spendthrifts, or the parents want to put conditions on as to when the child would get the money. What about a spousal trust? How would a spousal or a spouse trust be used?
Yeah, so that's actually one of the areas that we see trusts used the most in estate planning. A spousal trust is exactly what it sounds like. It's a trust for the benefit of a surviving spouse. And so that can be all of your property or some of it. But essentially what happens is, on the death of a testator, they establish this trust for the benefit of their spouse exclusively during the spouse's lifetime. Only the spouse can benefit from the income or the capital. And what it does is it allows your spouse to live in the way that they've become accustomed with you while you're alive. It keeps them looked after, clothed, fed, but beyond that, also, living at the standard they expected until they die, at which time whatever's left is protected for everybody else. And so where this is really common is in second marriages or third marriages, where you have a new spouse, but you have children from a previous marriage. A lot of people are uncomfortable with the idea of not leaving anything for their kids, but they do still understand they've married this person and they have an obligation to look after them. So that's a nice way to help balance it and say to your children, well, while your step parent or my new spouse is alive, they're being looked after with my resources, and whatever's left at the end is going to go to you.
Okay, makes perfect sense. What about a situation where the adult children are very well off themselves, like they're doing very well, and the parents don't want to leave the money outright to them because it would just add to the children's portfolio, and the income again would be taxed at the children's marginal tax rate. Can a trust be used in that situation as well?
To a degree, yes. It sort of depends on the type of the trust. So, for example, a testamentary trust gets certain tax advantages for the first 36 months of the existence of that trust. So after the date of death, and then after that, the tax rates will go back up to top marginal rates. But for a short period after death, a testamentary trust can be used to manage some tax consequences. Certainly you can try to manage your the funds that are going to go to your children in that way. Where you might be more concerned there is making sure there's something left over for the grandchildren, or something protected from your son or daughter-in-law, because putting property in a trust can have a really important creditor protection function including in the matrimonial property context. So that's one really good opportunity to use a trust.
Okay, that's good. Okay, well, switching to the intervivos trust. In what kind of a situation would an intervivos trust be used, given the higher marginal tax rates?
Yeah, so you can use them in a lot of situations. A lot of times you see them in, high net worth families will implement them to share resources and to share wealth, while taking advantage of some other tax benefits to a trust. So, for example, there's sometimes a limited ability to split income using trusts. Sometimes there's an ability to multiply capital gains exemptions if you're a business owner through a trust. So there's all kinds of reasons you would do that. But again, the other function, leaving aside the tax, is to help manage family wealth in a way that doesn't relinquish control. So for example, if we have mom and dad who are very wealthy and they have children who are still finding their way, they maybe are adults, but they're still finding their way. This is a way for parents to help them get some more wealth, some more money from the family resources, while still retaining some control over how the money is used. Okay.
What about, let's say that the parents have a family cottage.
Right.
And, when the parents pass away, they don't know what to do with the cottage. Can they put a cottage in a trust and leave it in there for perpetuity?
Well, not for perpetuity. Trusts do have to end at some point. They can't go on forever and ever. And typically what you set up in the trust is a reference age. So you take a life and you set your trust to terminate at the end of a particular period. So one way we used to see it is 21 years after the death of the last living descendant of the settlor at the time the trust is settled, which can give your trust a very long life. Sometimes you see 21 years from the date of death of the last grandchild of Queen Elizabeth, something like that. So your trust has to end. But to your point about the cottage, yeah, you can put a cottage in there. And when you do that, though, it's a good idea to make sure there's also some money so that the cottage can be kept up. Because often people can run into the problem of, okay, we have this cottage, but who's going to pay for the upkeep and the property taxes and the maintenance?
Shannon, what about, can a person set up a trust for themselves while they're still living?
Oh yeah. And this is you might see that, for example, in an alter ego trust, where you take your property and you set it aside for yourself, and it's almost like carving it off of you and putting it into a different bucket, if you want to call it that. And you can do that for tax reasons, among other things. But one of the dangers of setting up a trust for yourself, or setting up a trust where you're the beneficiary, is sometimes you can engage certain tax attribution rules. So before setting aside anything in trust for yourself, you're going to want to get good tax advice, good sound tax advice.
Okay, right, that makes sense. Okay, Shannon, when it comes to using a trust for confidentiality reasons, can either a testamentary or an intervivos trust be used, or is it more common to use one kind of trust versus the other?
Well, so confidentiality, like as against whom? As against creditors? As against?
Well, even, let's say creditors, but also other family members or just the general public. Because to my understanding, when a will is probated, any nosy person can go down, read through what a person's assets are. But with a trust, I understand that that it's not public knowledge.
Yeah, no, that's right. And in fact, there was recently it was covered quite a bit in the media, but there was recently a case, the Sherman estate, Barry and Honey Sherman,
Yeah.
where for exactly that reason, the family, the surviving family, decided they didn't want the probated will to be a matter of public record. So they asked the court to seal that court record so that others couldn't see it. And in fact, ultimately that was struck down by the Supreme Court. They said you can't seal these things, it's public knowledge. So to your point, if you have a testamentary trust and your will is probated, there's a very good chance, an excellent chance, in fact, that it's going to be public. On the other hand, you're right, an inter vivos trust is private. There's not many people who can demand information about it. And when I say there's not many people, what I'm referring to is trustees have an obligation to account to the beneficiaries, and that can be it can't be totally contracted out of, but the trust deed can give you some limits on that. And then another character in this whole drama that often will ask questions about trusts is our good friends, the Canada Revenue Agency. So, subject to certain exceptions, yes, trusts are a lot more private. Inter vivos trusts are a lot more private.
All right. So if, let's say that I'm a wealthy individual, I have an individual that I want to leave money to, or that I want to look after financially, I could set up a trust, put in property in the trust, name a beneficiary, the person that I want to look after financially. I don't want my other family members to know about her. I can do that, and the other family members would never find out about her. They may know that there's a trust, but they wouldn't know who the beneficiary is.
Yeah, unless they have a right to know, unless they're somehow connected to the trust. If they're a beneficiary or a trustee, then you're right. The beneficiaries of the trust are who they are. Again, there's still the exception that there's disclosure rules to various entities like the CRA, like probably your banks, but your neighbor doesn't get to know, your coworkers don't get to know. It's private.
Okay. And with that, say an inter vivos trust, can the property that's within that trust, does it have to be a Canadian domiciled property? Or if I have a cottage in Florida, can I put that into a trust, into just the same trust, one trust?
Well, I mean, in theory, you could. The challenge will be that it can attract different tax consequences. And of course, different jurisdictions have different laws. So, your trust is typically governed by the laws where it's, your trust will choose its law. You'll say this trust is governed by the laws of Alberta. But if you've got Florida real property in there, it may be that there's a bit of an intersection of Florida law as it relates to your cottage, your condo in Del Boca Vista or whatever. And sometimes that can come into conflict and it can create interpretation problems or tax problems.
Yeah. So in a situation where there's, foreign property, is it best to set up a separate trust for that foreign property?
Absolutely.
Yeah. Okay.
Yeah.
And trusts aren't something just in Canada. Like they exist in the US and Europe and whatnot.
Yeah, they exist. I'm not going to say everywhere. Trusts are more common in common law jurisdictions. But they also exist in other places that are not common law jurisdictions. So, for example, in Mexico, a lot of Mexico properties are held in trust or something that resembles a trust. So it's not just a Canadian thing; they're everywhere.
Okay, but Quebec's under civil law, so they're in Quebec as well.
They do still have trusts in Quebec. They're governed by the civil code. They have something to approximate a trust, and in fact, they are trusts, but not necessarily in the same way that we understand a common law trust.
Okay. Shannon, in setting up a trust, is that something that I can do myself, or what would you? What is your advice to people when it comes to setting up a trust?
So there's a big difference between can and should. You absolutely can create a trust. Like we said, all you have to do is express an intention about some defined property to set it aside for a person. But whether you should do that by yourself is another question. Trusts are really not suitable for DIY. If you're creating a trust, you you should be getting good tax and legal advice. And the reason for that is trusts rather, they're complicated creatures. They have all kinds of special tax rules that apply to them. They have all kinds of governance rules that apply to them and restrictions. And what you don't want to do is set up a situation where your trustee is dealing with property that they can't meaningfully administer, or where they are their hands are tied a little too tightly or not tightly enough, or where they've got a real tax problem just by accident from the way this thing was set up. So I don't recommend that people try to DIY their trust.
Okay. That makes sense.
Yeah.
That actually leads me to another question, though. In naming the trustee, what if the trustee finds out that they're the trustee and they don't want to be the trustee, or they don't feel they're even capable of being the trustee?
Yeah, so you can't force someone to be a trustee. It comes with really, really heavy obligations, and a person has to accept them. So provided that trustee or that person named as a trustee hasn't actually acted, hasn't intermeddled, as we say, or started in their acting as trustee, they can walk away. They can say, I'm not doing this, I'm renouncing, thank you very much. Where it gets a little more tricky is that if this person has started to act and then wants to no longer act, and sometimes, depending on the terms of the trust, that can actually require you to take a court application to have that person excused, to pass their accounts, meaning to look at everything they've done over the terms of the trust, and then to let them off as a trustee. So it can actually be quite a process.
Yeah, sounds like it. And then when it comes to, I guess, reporting. So let's say I'm the trustee. I agree to be the trustee. I'm managing the funds, following the terms and conditions. How often, or is there a reporting process? Or do I legally have to report, like obviously to the CRA, but do I have to report to the beneficiaries or the government? Is there any reporting structure set up?
Yeah, so in terms of your reporting to your beneficiaries, that is called accounting to beneficiaries. An executor of a will, who is a trustee, by the way, because they're holding the estate property for other people, they have a minimum obligation under legislation to report every 2 years to the beneficiaries. And what that can look like varies a lot, and it depends on what the trust is and how the property is being managed. Under an actual inter vivos trust, you can set up, at the time the trust is being created or settled, you can set up rules about how that reporting is supposed to look and how frequently it's supposed to happen. But a general rule of thumb is that it should be every 2 years at a minimum, or at request by people entitled to request it. Now, in terms of your reporting to governments and to revenue agencies, while you're filing tax returns annually for your trusts, and that can come with certain reporting obligations. There's new changes coming for what reporting has to be done. So trustees are now going to be reporting a lot more to the CRA, including the names and social insurance numbers and addresses of the beneficiaries. But that reporting will also be presumably annually as you're doing your tax filings.
Okay. I think a lot of people maybe don't believe that a trust is appropriate for their financial situation, partly because of the maybe the costs involved in setting up the trust, maintaining the trust. Is there a minimum size that the trust should be in order for it to be financially worthwhile?
That is a great question. And I can't really put a number on it because there's so many different reasons you'd use a trust. But yeah, it is an important part of the calculus. You have to think really hard about, if we assume that it's going to cost X dollars to pay lawyers and accountants to figure out if we should set this up, and it's going to cost paying your accountant to do annual tax returns, and it's going to cost money to trustees are actually entitled to be paid too. So that's a factor to build in. And then if you look at it and go, well, we've got $20,000 investment in this trust and it's not making money this year, you do have to think carefully about what what is the cost and the benefit? So that's something that you do want to chat with your advisors about, because it may be that in your financial circumstances, it just doesn't make sense.
Okay, I see that. And maybe just one final question. With a testamentary trust, so you have the personal representative or the executor.
Right.
And then, but you could have a separate person as the trustee.
Absolutely, you can. And that's quite common. So the default rule when you're making a will is you appoint your personal representative, your executor, and that's the person who's in charge of the whole thing. But some wills will actually go so far as to say, here is my trust for my daughter Jane. And when Jane reaches a certain age, Jane will be the trustee of Jane's trust. Or, maybe it's Jane is my granddaughter, and Jane's mom is going to be trustee of Jane's trust. So yeah, you can absolutely have different people appointed to manage different buckets of money in a will.
Okay, it looks like we're just about out of time. Thank you again, Shannon, for being our guest. The insight that you provided was excellent, so thank you very much. Shannon, if our audience wants to get in touch with you, how can they do that?
Well, thanks, Gary. If anyone would like to get in touch with me or my colleagues at Carscallen, you can reach me at james@carscallen.com or on our website, carscallen.com.
Okay, perfect. I also want to thank our sponsor, Customplan Financial Advisors, the award-winning MGA that provides exceptional support and resources to the independent financial advisor. Visit their website at customplanfinancial.com. You can find this podcast at YouTube, Spotify, or at financialpodcast.ca. If you'd like to receive notification as to when new podcasts are available, please subscribe at financialpodcast.ca. If you know of someone who would make an excellent guest, or if you have a topic that you'd like us to talk about, or if you want to provide us with some feedback, please email us at contact@financialpodcast.ca or info@financialpodcast.ca. Thank you again, Shannon, for being our guest. And to everybody else, enjoy your day.
The views expressed here are those of the participants and not those of Customplan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.